folks, this is Doc's Market Minute for Monday, May 4th. You know, when we learn to trade, we're often taught that we have to go kind of against the grain. We have to be contrarian traders. In other words, we have to be fading the herd in order to make profits, and that's one of the toughest things to learn. Frankly, because it feels so bad to do. It feels insane to be going against the herd. Until you eventually learn that going against the herd really is the quickest way to generating profits. Now here's a good example. Here's a stock called Stratasys. Now you take one look at this chart with a monthly and a weekly and the daily all in downtrends, and you go, wow, this is a great stock to short. Well, that's what the average retail trader thinks, is that this is a great stock to short. And then they're absolutely horrified when they take a short position down after just an absolute meltdown like this, and then all of a sudden they see it rally like crazy. It just doesn't seem to make sense as to why it would do that. Probably what's going on here is it's literally run out of sellers, and all of a sudden there's nowhere for the stock to go, at least in the short term, until it rises higher. And this is what's happening when we get into a stock which is selling off like this. It tends to rip to the upside on these corrective counter trend moves. Bear market rallies are some of the strongest rallies that you'll ever see, because these are shorts trapped on the wrong side of the position that have to buy back to cover. So this is why we see these incredible, just screaming moves higher on here, much like this one was here. And then the trend resumes again. So what we're doing is we're seeing if we can take advantage of these, whether or not we sell something bullish down here or we establish something bearish again. But the point here is that you don't want to be taking a bearish trade on something like this until you see that counter trend rally. So what I'm talking about today is there any way that we can go against the grain and take something bullish? Well, yes, there is. It's a very, very aggressive trade, because you're literally standing on the train tracks in front of the freight train coming down on you, and you're saying, well, there's no way it's going to get this far. Now, the edge here for a trade like this is if we take something like a bull put spread, which is right at the money. So if we're selling that option, it's right at the money, and we're buying an insurance option that's just below there so that we cap our risk, we can essentially get a 1-to-1 reward to risk ratio on this trade, which has got a 50% chance of winning to begin with. But when we combine that with a fractal energy analysis showing that this thing is pretty much done to the downside, and we should see some type of gap fill or at least some type of measured bounce in the next few days. If we've sold something that's only got maybe 4 or 5 days left to live, then I think we've got actually a fairly decent probability of coming away with a nice profit on this trade. And we can do the same thing in reverse. Again, it looks insane to short something like this, like Yum, but again, we're taking the opposite side of the trade when every retail trader in the planet sees Yum brands moving to the upside, but what they don't see is the exhaustion signals on here showing it's extremely likely to fade to the downside from here. So in this case, what we can do is actually set up the opposite of the previous trade. We can set up a bear call spread up here. We can sell an at the money call and then buy an out of the money insurance strike for this to make our trade setup as a 1-to-1 reward to risk. And again, starts off with a 50% probability of success, but we have an overdone move to the upside. So again, this is where the retail crowd sees this thing going up, buys into it, runs out of buyers, and at some point it needs to fade back down, either sideways to down from here, even if it's just setting up a bull flag in this area. And that's usually all it takes to be able to profit from an at-the-money call spread like this. So it seems like we have a new paradigm about how to trade markets. It's not quite the same as it used to be, and we don't have the implied volatility that we used to have to work with for a lot of these trades that made selling options easy. So what we have to do instead is look for very specific applications of this, set ourselves up with a correct reward to risk on the trade in case we're wrong and it keeps on going, and then go against the herd, fade the herd in these cases, and I think that should still give us enough edge to create a positive expectancy system. That's it for today's Market Minute. Thanks for listening, folks. See you tomorrow.